Hello everybody, welcome to our weekend edition of Market Review. Let's see what happened in the market this week. We had Microsoft had a decent week, was up 1.89. Tesla with the split news was up 7.32. Starbucks was up over 4%. Apple had to retreat a little bit. It had a nice run. I think it was 12 days in a row that it was up. Visa and MasterCard had good days, 3.6 and 4.28, but the rest of the financials, look at all these banks. JPM down 4.66. Bank of America was down 6.47. It was a very spotty week. We have Walmart there at 5%, but Amazon down 0.74. It was difficult to play. It was very spotty. It was very choppy. The Friday session, we started off with a little bit of a sell-off. We were down quite a bit for a while, and then we had this end of day rally right here, and we ended up a little more than 0.25% for the day. And it honestly not unexpected. If you recall, on the last video I said that the points of resistance were SPY was going to fill that gap, and I said it when we had this big green candle over here, and I was hoping for a bounce off of that gap fill. And you could see on that Wednesday session, once we got to that gap fill, we did get a little bit of a bounce, but it didn't hold. It kept coming down. So the next point of resistance, of course, was the 23.8 Fib Retracement line, and we went down right to that Fib Retracement line. You can see the Fib Retracement line was right here. We overshot it for a little bit. That's called a spike bottom. Once we get that spike bottom and we overshoot that retracement line, we begin our climb back to the top. It was a textbook trap. Really what the market did there is it trapped a bunch of bears. You could see on the open interest by strike, there was a lot of puts that expired on Friday. They were worthless. And of course, there was a lot of calls that expired that were worthless. You know, this, if you get on the chat often, you'll hear me refer to this as max pain. And our max pain for the week was at 452. You could see it right here at 452. You have all these puts expiring worthless, and at 452 you have all these calls expiring worthless. And we closed the week at 452. I don't think it's a coincidence. That's just the way the market seems to move and to play. Smart money knows what they're doing. The smart money is selling all these puts and collecting the premium, and at this point they weren't buying calls. But what we saw at the end of the week was the smart money starting to move towards hedging their positions, because they do sell they do sell puts, and they hedge their position by buying calls. And you could see on the major index combined hedge position, you could see that the call buying from the institutions was just massive towards the end of the week. And why is, you have to ask yourself, why are the institutions buying so many calls? And of course, we have to look at the seasonal calendar that shows us. This particular graph right here is on a 15-year average. On a 15-year average, April for the S&P 500, it has been up 13 of the last. I don't have 2020 on here, so but on April 2020. The market was up, so it's been up 14 of the last 15, and it's actually, when I look at the 25-year average, it's been up 21 of the last 25 Aprils in the last 25 years, and it's not just up, it's not just a little up. Look at the percentage return we have for April, 3.06 on the S&P 500 for the month of April. That is an amazing climb for a month for the S&P 500. That's the index as a whole. Now, I think that the reason you saw so much call volume on the hedger, on your hedger position, was because they are expecting to have a little bit of a climb in April. You could see that our probability calendars right here, for the Russell, half the month is over 60% bullish. On the Nasdaq, we have a little over a quarter. The S&P isn't as bullish. There's some sectors there that become weak, but the Russell, the Nasdaq, and then we have the Dow over here that has a few bullish days but not as many. Reason for that is the Dow does have some defensive positions, the S&P does have some defensive positions, and the Nasdaq and the Russell, these are risk-on positions. That's why you see them climb a lot in the month of April, and you don't see the S&P and the Dow climb as much. Now, something that, when I sit back on the weekend and look at my positions and look at the market, try to analyze what happened. A lot of times, during the week, I get wrapped up in what I'm doing. I get wrapped up in the 5-minute chart, 10-minute chart, 15-minute chart, and I get caught up in all the micro trends. And then I step back on the weekend and look at the macro trend, look at the overall picture, and try to analyze what happened. Something that came to me this weekend when I was looking at the charts is when I do a Fib retracement on the SPY, I could tell that from the, when we do this retracement from the top to the bottom, we came back to about the 75% line and then retraced back down to 61.8. And that was a huge climb. Now, how far we'll retrace, I'm not sure yet. We'll cover that in a second. But something I want to show you is when you look at the Nasdaq, we only came up, we didn't even make it to the 61.8. We made it to the top of the trend line. We never made it to the 61.8. When you look at the Russell, which some of you have heard me say that the Russell typically leads the change in market direction, the Russell didn't even make it to 50%. It hasn't even retraced 50% of its losses. That's a little concerning. You have to ask, why does the S&P retrace to 70%, the Nasdaq to 61.8, and the small caps didn't even retrace to 50%? That's a little strange. But a lot of it has to do with the sectors and the sector rotation. The S&P does have sectors like energy that aren't as prominent in the small caps, and energy for the last 30 days have been on a tear. Of course, right there you have utilities, again another defensive position that's been on a tear. Real estate has been turning around, and it's been helping hold up the market. You have the healthcare sector right here, and those are the sectors that for the last 30 days have led the charge, and it's not what we want to see if we want the market to really turn around. If we really want the market to turn around, we want to see the XLK, the XLY, and the XLF turn around. That's consumer discretionary, financials, and technology. Once those three turn around, and when you see those three on the top of the list, that's when you know the market is really, really bullish. Now again, it's April. We expect to be bullish in April. So why do we have such safety positions leading the charge? We have April right here, and if it's a bullish month, why are safety positions leading? Well, this black line up here indicates the 20-year average, not excluding any years. The 20-year average of the S&P 500, not excluding any years. You see, it's a steady climb throughout the year. May, sell in May, go away. You always have that. May is the beginning of the worst 6 months. April is the last of the best 6 months. But let's look at what happens on second year or midterm election years. On midterm election years, you have this decline that happens and across the market that a lot of times retests the low of the beginning of the year. Now this year, our decline came all the way down here. We bounced up, and what I hope does not happen, and I don't think it's going to happen, is these big declines that supersede and go further than the first decline of the year. If that does happen, we're looking at a retest of or the retest of the lows of the year, or maybe even filling the gap at 400. And I don't think that's likely, even though there's a lot of talk of recession. I think a lot of the recessions are self-fulfilled prophecies. We kept talking about the yield inversion. I heard about it all week. I keep hearing everybody talking about it, and I say it all the time. Correlation does not mean causation. There has been 2 times in the past where there was a yield inversion and we didn't have a recession. It's not uncommon. Not every single inversion leads to a recession, but it's an indicator that we use to tell us what's going to happen in the future. But really, the only thing it's telling us is that the 2-year bond is telling us that we're expecting less inflation in 10 years than 2 years. That's what the inversion means. That's really all it's saying. There's going to be more inflation in 2 years than there's going to be in 10 years. That's not bad news. It's not bad news at all. Really, the only thing that means is you have your net inflow of bonds. You could see that nobody was buying bonds. There was a big bond sell-off, especially on the 2-year. And now that the yields have gone up, there's an inflow of bonds, of bond buying. That's all it means. It really just means that some money is going to come out of the stock market and move back into the bond market. That's all it means. That is a little worrisome because less money in the market makes it less liquid. It moves slower, and the turnarounds won't be as drastic. Now, we did just finish the quarter. The quarter was down, which is not common for the first quarter to be down. And you could see on this chart that when the first quarter is down, the year tends to be down. There's been a couple instances where the year ends up after the first quarter being down, but you can see there that's not a big gain. This is an oddity right here, 1982, and of course that's because Ronald Reagan. But the years that were down 29%, down 23%, down 1%, down 6%. So it's a bad sign. Yield inversion, that's a bad sign. Midterm election year, that's a bad sign. There's a lot of things telling us that if April is as bullish as we think it's going to be, we should take advantage of exiting positions that we're kind of iffy about, and wait to see how it plays out. Now, of course, I think that day trading in this market is very lucrative, but holding in this market, not so much. Please take the time to give us a thumbs up, subscribe to the channel, and it's the weekend, so go out, mow your lawn, tear some muscles, get in front of your computer and draw some charts so you know where we're gonna be at the end of the week. And I will talk to you later this week. Have a good weekend.